concept of valuation is not new. It is as old as commerce itself, deeply rooted in human exchange. Early merchants needed to assess the worth of goods. They did this to facilitate fair trades and build trust. This fundamental need to determine price laid the groundwork for more formal valuation ideas. Even without complex spreadsheets or financial models, the core idea was present. People intuitively understood that some items were more valuable than others. This understanding was based on scarcity, utility, and demand, principles still relevant today in our sophisticated financial world. Classical economists significantly advanced these early notions. Thinkers like Adam Smith explored the intrinsic value of assets and labor. They debated what truly constituted wealth and how it should be measured. This period saw the development of theories around supply and demand. These theories provided a framework for understanding price determination in markets. The focus was often on tangible assets like land, commodities, and physical goods. The valuation of ideas or future potential was less defined, but the seeds were sown for future exploration into these more abstract concepts, setting the stage for modern corporate finance. The rise of corporate finance in the 20th century brought more structured approaches. As companies grew larger and more complex, the need for systematic valuation became critical. Investors needed ways to assess the worth of shares in these burgeoning enterprises. This led to the development of early financial metrics and ratios. These tools helped compare companies and gauge investment risk. The stock market crashes also highlighted the dangers of misvaluation. They underscored the importance of sound, rational methods for determining corporate worth, pushing academics and practitioners to refine their techniques. These historical foundations are crucial. They remind us that valuation is part art, part science. It has evolved significantly from simple barter to intricate financial modeling. However, the underlying goal remains the same. It is to understand and quantify the economic worth of an asset or a company. This historical context helps us appreciate the tools we use today. It also reminds us that even the most sophisticated models are built on fundamental economic principles. These principles have guided human economic interaction for centuries, proving their enduring relevance in our modern, fast-paced markets. In the world of startups and venture capital, certain terms are fundamental. Pre-money valuation is one such critical concept. This term refers to the value of a company before it receives an investment or financing. It represents the worth agreed upon by the existing owners and the new investors. This figure is a starting point for negotiations. It reflects the company's current achievements, market position, and future potential, all assessed prior to the infusion of new capital. Essentially, it is what the company is deemed to be worth as is. Post-money valuation, conversely, is the value of the company immediately after an investment. It is calculated simply. You add the amount of new investment to the pre-money valuation. For example, if a company has a pre-money valuation of $4 million and raises $1 million, its post-money valuation becomes $5 million. This figure is important because it determines the percentage of ownership the new investors receive. The investor's stake is their investment amount divided by the post-money valuation, shaping the cap table significantly. Understanding the distinction between pre-money and post-money is crucial for all parties involved. For founders, a higher pre-money valuation means they give up less equity for a given amount of investment. This minimizes their dilution. For investors, the pre-money valuation influences the price per share they pay. It directly impacts their potential return on investment if the company succeeds. A clear grasp of these terms prevents misunderstandings. It ensures that negotiations about ownership and control are based on a shared understanding of the company's financial state. These valuations are not just numbers, they are powerful signals. They reflect market sentiment, investor confidence, and the perceived trajectory of the startup. A strong pre-money valuation can attract further investment and talent. It can also set high expectations for future performance. Conversely, a lower valuation might make fundraising easier in the short term, but could lead to greater dilution for founders. Therefore, arriving at these figures involves careful consideration of various factors, including comparable company data, market conditions, and the specific strengths of the startup. When it comes to determining a company's worth, several methods are employed. One prominent technique is the discounted cash flow, DCF, analysis. This method attempts to estimate the value of an investment based on its expected future cash flows. The core idea is that money today is worth more than the same amount of money in the future. This is due to its potential earning capacity. Future cash flows are therefore discounted back to their present value using a discount rate. This rate reflects the riskiness of those cash flows. The DCF method requires making several assumptions. These include forecasting future revenues, costs, and capital expenditures. It also involves selecting an appropriate discount rate, often the weighted average cost of capital, WACC. While DCF analysis is theoretically sound, its accuracy heavily depends on the quality of these assumptions. For early-stage startups with uncertain futures and limited historical data, projecting cash flows can be particularly challenging. This makes the DCF method more art than science in such contexts, requiring careful judgment and sensitivity analysis for its application. Another widely used valuation approach is the comparable company analysis, often called comps. This method involves comparing the company being valued to similar publicly traded companies or recently acquired private companies. Key financial multiples such as price to earnings, PE, price to sales, PS, or EV, EBITDA, are calculated for the comparable companies. These multiples are then applied to the corresponding financial metrics of the target company to derive an estimated valuation. This relative valuation approach provides a market-based benchmark. Comps are popular because they are relatively easy to understand and implement. They reflect current market sentiment towards a particular industry or type of company. However, finding truly comparable companies can be difficult, especially for innovative startups with unique business models. Market conditions can also skew multiples, leading to over- or undervaluation if not carefully considered. Often, valuators use a combination of DCF and comps, along with other methods, to arrive at a more robust valuation range, acknowledging the strengths and weaknesses inherent in each individual technique. The valuation landscape in 2025 is significantly shaped by prevailing market conditions. We are witnessing a period of rapid technological advancement, particularly in artificial intelligence, AI. This has led to heightened investor interest and consequently inflated valuations for many tech and AI companies. The promise of disruptive innovation and vast market potential drives this enthusiasm. However, it also introduces a degree of frothiness into the market. Investors are often willing to pay high premiums for companies perceived to be at the forefront of these technological waves. Global investment patterns also play a crucial role. Capital flows across borders, seeking high-growth opportunities. The availability of venture capital and private equity funding has a direct impact on startup valuations. In times of abundant liquidity, valuations tend to rise as more capital chases fewer deals. Conversely, when capital becomes scarcer or more risk-averse, valuations can compress. As of early 2025, while there's still significant capital allocated to tech, there's also a growing caution. Investors are increasingly scrutinizing pathways to profitability, not just growth at all costs. The tech sector, especially software as a service, SaaS, and AI-driven businesses, continues to command attention. Companies in these areas often exhibit strong recurring revenue models and high scalability. This makes them attractive investment targets. However, the high valuations come with immense pressure to deliver on ambitious growth projections. The market is quick to punish companies that falter or show signs of slowing momentum. This creates a dynamic where early promise must be quickly converted into tangible financial results to sustain lofty valuations. Furthermore, macroeconomic factors like interest rates and inflation influence valuation multiples. Higher interest rates generally increase the discount rates used in DCF models, putting downward pressure on valuations. They also make alternative investments like bonds relatively more attractive. Inflation can impact a company's costs and pricing power, affecting its profitability and, by extension, its valuation. Navigating these complex, interconnected factors requires a nuanced understanding of both micro-level company specifics and macro-level market trends to accurately assess value in today's dynamic environment. Section 5, Valuation in the Real World, Lessons from Stripe, Figma and OpenAI. Real-world examples vividly illustrate the complexities and volatility of startup valuation. Stripe, the online payments giant, provides a compelling case study. For years, Stripe saw its valuation soar, reaching a peak of $95 billion in early 2021. This reflected its strong growth, market leadership, and the e-commerce boom. However, by early 2023, market conditions shifted. Tech valuations corrected, and Stripe conducted an internal valuation round at around $50 billion, later raising funds at this level. This adjustment highlighted how external market forces and internal performance recalibrations can dramatically impact even established private companies. The proposed acquisition of Figma by Adobe, though ultimately terminated due to regulatory hurdles, also offers insights. Adobe offered a staggering $20 billion for the collaborative design software company in late 2022. This valuation, roughly 50 times Figma's annual recurring revenue at the time, was a testament to Figma's disruptive product and rapid growth in a key market for Adobe. While the deal did not close, the offer price itself served as a significant market signal. It demonstrated the premium large tech companies were willing to pay for strategic assets that could accelerate their growth or defend their market position, even in a cooling market. OpenAI's meteoric rise presents another fascinating example, particularly in the AI space. The company behind ChatGPT saw its valuation skyrocket in a very short period. From a reported valuation of around $29 billion in early 2023, it was reportedly seeking funding, valuing it at $80 to $90 billion by late 2023 and into 2024, and has continued to attract significant investment. This rapid appreciation underscores the immense investor appetite for generative AI and foundational models. It also highlights the challenges in valuing companies with groundbreaking technology but uncertain long-term revenue models and significant ethical and competitive risks. These cases collectively demonstrate that valuation is not static. It is a dynamic process influenced by a company's progress, market sentiment, competitive landscape, and macroeconomic trends. Stripe's journey shows that valuations can adjust downwards. Figma's offer illustrates strategic premiums. OpenAI's ascent reflects the hype and potential of transformative technologies. Understanding these real-world scenarios helps founders, investors, and employees appreciate the fluid nature of value in the startup ecosystem and the various factors that can cause it to shift, sometimes dramatically and quickly. Section 6. The Founder's Perspective. Valuation as a strategic lever. For startup founders, valuation is far more than just a number. It is a critical strategic tool that impacts nearly every aspect of their journey. During fundraising, the valuation directly determines how much equity they must give up to secure capital. A higher valuation means less dilution, allowing founders to retain more ownership and control over their company's destiny. However, an excessively high valuation can create unrealistic expectations. It might make future funding rounds difficult if progress doesn't match the lofty price tag, potentially leading to down rounds. Valuation also plays a crucial role in attracting and retaining talent. Many startups use equity in the form of stock options or restricted stock units as a key component of employee compensation. The perceived value of this equity is directly tied to the company's valuation and its future growth prospects. A rising valuation can significantly boost employee morale and motivation. It makes their stock options more valuable, aligning their financial interests with the company's success. This helps startups compete for top talent against larger, more established companies. Beyond fundraising and talent, valuation influences strategic decisions. It can affect a company's ability to make acquisitions, as its stock can be used as currency. A strong valuation can enhance a company's brand and credibility in the market. This can open doors to partnerships and attract customers. Conversely, a struggling valuation might signal underlying problems, making it harder to achieve these strategic objectives. Founders must therefore manage their company's narrative carefully. They need to balance ambition with realism to build a sustainable valuation trajectory. Therefore, founders often walk a tightrope. They aim for a valuation that reflects their company's potential and minimizes dilution, yet they must also ensure it is credible and sustainable. This requires a deep understanding of their market, their competitive advantages, and the expectations of investors. Setting an appropriate valuation is a delicate balancing act. It requires not only strong negotiation skills, but also a clear vision for the company's future and the ability to articulate that vision compellingly to potential investors and employees alike, making it a cornerstone of entrepreneurial strategy. Section 7. The Investor's Calculus. Balancing risk, reward, and dilution. From an investor's standpoint, valuation is a central piece of the investment puzzle. Investors, particularly in the venture capital and private equity space, are seeking substantial returns to compensate for the high risks associated with early-stage companies. The entry valuation at which they invest is a key determinant of their potential exit multiple. A lower entry valuation, all else being equal, offers a higher potential return if the company succeeds and achieves a significant exit value through an IPO or acquisition. This is a fundamental principle of their investment thesis. Investors meticulously analyze a startup's valuation using various methods, including those previously discussed like DCF and comparables. They also consider the team's strength, market size, product market fit, competitive landscape, and scalability. For venture capitalists, the potential for a 10 times or even 100 times return is often a key consideration, as the power law dictates that a few successful investments must cover the losses from many failures in their portfolio. Therefore, they are looking for companies with the potential for explosive growth, even if it means paying a higher, yet justifiable valuation. Dilution is another critical factor for investors, just as it is for founders. While investors receive equity in exchange for their capital, they also face the risk of their ownership stake being diluted in subsequent funding rounds. Sophisticated investors often negotiate for protective provisions. These may include anti-dilution clauses, liquidation preferences, and pro-rata rights, which allow them to maintain their percentage ownership by participating in future rounds. These terms are negotiated alongside the valuation and are integral to the overall deal structure, protecting their investment. Ultimately, an investor's decision hinges on whether the proposed valuation offers an attractive risk-reward profile. They must believe that the company can grow significantly beyond its current valuation to generate a satisfactory return. This involves not only quantitative analysis, but also a qualitative assessment of the founder's vision and execution capabilities. The valuation must make sense within the context of the investor's fund strategy and the broader market conditions. It is a complex judgment call, blending rigorous financial modeling with a deep understanding of startup dynamics and market psychology. Section 8. Beyond the numbers, people, psychology, and the impact of valuation. Valuation figures, while seemingly objective, carry significant psychological weight for everyone involved in a startup. For employees, particularly those holding stock options, the company's valuation can be a powerful motivator or a source of anxiety. A rising valuation often translates to a sense of progress and a belief in the future wealth-generating potential of their equity. This can foster loyalty and encourage employees to work harder, knowing their efforts contribute to a tangible increase in their potential financial outcome. It binds them to the company's mission. Conversely, a stagnant or declining valuation or a down round where the company raises funds at a lower valuation than before can be demoralizing. It may lead employees to question the company's trajectory and the value of their stock options. This can impact morale, productivity, and employee retention. The psychological impact extends to recruitment as well. A highly valued company often finds it easier to attract top talent as candidates are drawn to the prestige and potential financial upside associated with a unicorn or a rapidly growing startup. The psychology of valuation also heavily influences founder and investor behavior. Founders might become overly attached to a specific valuation number, sometimes leading to difficult fundraising negotiations or unrealistic expectations. This anchoring bias can be detrimental. Investors, too, are susceptible to herd mentality, sometimes chasing deals at inflated valuations due to fear of missing out, especially in hot sectors like AI. This can create valuation bubbles that eventually correct, causing widespread pain when they burst. Understanding these behavioral biases is crucial. Therefore, a company's culture can be subtly shaped by its valuation narrative. A culture that excessively focuses on the valuation number itself, rather than on building fundamental long-term value, can become short-sighted. It may prioritize metrics that drive up short-term valuation over sustainable growth and profitability. A healthier approach involves transparent communication about how value is created and how valuation reflects underlying business performance rather than treating it as an end in itself. This fosters a more resilient and intrinsically motivated workforce focused on the core business. Section 9. The Horizon of Valuation: Future Trends and Emerging Challenges. Looking ahead, the practice of startup valuation is poised for further evolution, driven by technology and changing market dynamics. One significant trend is the move towards more automated and real-time valuation models. With the increasing availability of vast data sets and advancements in machine learning, algorithms can potentially provide quicker, more data-driven valuation estimates. These tools could help standardize certain aspects of the valuation process, offering continuous insights rather than periodic snapshots. This could democratize access to valuation analytics for a wider range of stakeholders. However, the reliance on AI and automation in valuation also presents challenges. Models are only as good as the data they are trained on and the assumptions embedded within them. Biases in data can lead to skewed valuations. Over-reliance on automated tools might also diminish the crucial role of human judgment, especially in assessing qualitative factors like team strength, innovation potential, or disruptive market shifts, which are often critical for early-stage startups. The future likely lies in a hybrid approach, where technology augments but does not entirely replace expert human analysis. Another emerging challenge is the valuation of companies built on novel and rapidly evolving technologies, such as advanced AI, quantum computing, or synthetic biology. Traditional valuation metrics may not fully capture the potential or the unique risks associated with these frontier tech ventures. For instance, how do you value a company whose primary asset is a foundational AI model with immense potential but an unproven business model? Developing new frameworks and metrics that can adequately address these complexities will be an ongoing task for finance professionals and academics. Finally, increasing scrutiny from regulators and a greater emphasis on environmental, social, and governance factors are also likely to influence valuation practices. Investors are beginning to consider a company's societal impact and sustainability alongside its financial performance. How these non-financial factors are systematically incorporated into valuation models is still an evolving field. The future of valuation will require greater transparency, adaptability, and a more holistic view of what constitutes value in an increasingly complex and interconnected world, moving beyond purely financial metrics.